Hello, everyone. My name is Giovanni Calice. I'm an associate professor of finance at Loughborough University. It is a great pleasure. I've been invited to be the keynote speaker of this conference. And the topic I would like to discuss, I will present today, is based on my previous work on sovereign credit risk. I'm sharing now the presentation. And the paper is titled Sovereign Momentum Currency Return. And my co-author is Ming-Tzu Lin from the University of Essex. So what we do in this paper, we try to understand empirically the relationship between sovereign credit risk and currency returns. And we employ in our research in this paper sovereign credit default swaps as a proxy of sovereign credit risk. I'm sure you are very familiar, some of you may be familiar with these derivative instruments. So the sovereign credit default swap is simply an instrument by which a counterparty, a buyer of the position, pay to the seller of protection of sovereign bond a premium to hedge out default risk on the contract, which in this case is, of course, the probability of default of a sovereign entity, a country. So if sovereign bond defaults, the seller will compensate the loss of the buyer. So the market price of the CDS contract simply represents the likelihood of the sovereign default. Our novelty, our contribution in this paper is that we analyze, we take a cross-sectional perspective on this research question. Therefore, rather than employing a pure time series analysis framework, we rather use a cross-sectional approach because we are interested in understanding how this information in sovereign credit risk may actually be useful to predict currency returns. What are the key findings? Well, basically, we found that, consistent with our hypothesis, sovereign credit risk, past sovereign credit risk actually predict future currency spot returns. In particular, we found a significant cross-sectional currency portfolio spread in excess of the risk-free rate of return. We found up to 9.4% per annum between the highest and the lowest quintile sovereign CDS spread. The key implication for a portfolio manager, for asset manager working in financial institution, particularly in asset management firms or hedge funds, is that by relying on this information, a new profitable currency return strategy may be actually devised. The title of the paper is Sovereign Currency Momentum Return. And sovereign momentum currency return is actually, from the concept of currency momentum, is actually our key idea underpinning this paper. So the sovereign momentum, the currency momentum is the cross-sectional currency portfolio spread between past winner and loser currencies. In our framework, in our work, the currency return is between countries with past high and low sovereign credit risk. So this is the definition of sovereign momentum that we utilize in this paper. So why study on the cross-sectional impact? Well, there has been over the last years a very remarkable interest, especially by academics, but also by practitioners, market practitioners, in this area of research. Most of the papers are empirical by nature. There's been paper by Reinhardt Rogoff. These papers belong typically more closely to the macroeconomic finance literature. And Reinhardt Rogoff, they've also published a very very popular textbook on history of past crises. And so they found that typically, actually, sovereign default is followed by severe currency depreciation. So this is the main finding of this paper. But our paper is very much more closely related to other more recent studies that are more closely related to financial economics literature. And in particular, we borrow on Couder and Mignon, paper 2013, Delacorte et al. 2021, Foroni et al. 2018. And overall, this paper found a negative relationship between sovereign credit risk and currency returns. What we depart from, the way we depart from this paper is that typically we, in this work, we take, as I mentioned before, a cross-sectional perspective from an econometric point of view, while this paper typically follow a pure time series approach in their investigation. I've done past work myself in this area, as I mentioned before. I have a paper with Zhang 2021, another paper by Juan McDonald 2015, and Karnak 2016. They show an asymmetric relationship between currency return and sovereign credit risk. And in particular, this paper adopted CDS slope, which is basically the difference between the 10-year and the 1-year CDS spread. And they found that this time premium or slope positively impact on currency return. So economically speaking, that implies that the time structure of sovereign CDS spread seem to matter for forecasting excess returns on currencies, on exchange rates. Again, this paper mostly look at shocks to sovereign credit risk, and they also consider typically contemporaneous effects between the variable. We differ from the studies because, as I said, we take a cross-sectional perspective in the paper. So why it is important to study the cross-sectional impact? Because this tells us if an exposure to a certain factor or a source of risk is systematically important. And we know from traditional portfolio theory that investors may typically hedge out idiosyncratic risk by for example, including a large basket of assets, so by diversifying away idiosyncratic risk in a portfolio. But of course, systematic risk by definition cannot be hedged out. Systematic risk typically is market risk, as you know. So we try to basically tackle this question in this paper. Now, let me briefly sketch out the model that we use up front in our analysis, and then I will be moving into the more descriptive analysis and results of this paper. So we use a model, and we assume that government bonds are defaultable, and also we base our approach on the traditional interest rate parity. I just basically condensated in this slide, the derivation of our model, and one of the key equation, which basically show the relationship between the expected return on the currency, is the left-hand side in this equation, and of course you can observe here the currency return without sovereign default risk, and adjusted term, so it's the second term in this equation for sovereign default risk. So when we take into account of course, the possibility of default of a country entity given a shock, for example, a financial crisis in capital markets, in foreign exchange markets as well. And you know, by definition, by construction, this relationship is negative. So from this model, from this equation, we can derive a testable regression for sovereign risk and currency return. So it's given by this equation. Okay, and what we are interested empirically is, of course, looking at the sign and you know, the magnitude of this coefficient alpha and beta. If the information is lagged from the CDS side, then the impact on the currency return will not be synchronized. And instead, the impact will be delayed, indicating the sovereign CDS momentum effect. And in fact, this is exactly what we investigate in this paper, is the, you know, the speed of information between the sovereign CDS and the currency markets. In this equation, we term SCDS approach is the projected sovereign CDS spread by the past J information sets. Okay. By the way, the form of the past information is not specified. By the empirical stacks, we simply assume an equal weight of past information. So we just look at past information, okay? And as we will see later on in this presentation, we consider the last 1 month in this framework. So empirically, you know, we focus on the level of the past CDS spreads for countries in relation to currency return. So it is very, if you like, simple framework, because we focus on 2 key variables. One is the currency holding period return over the future H months. Okay, we test on raw return. And the results also when we use edge return. So we have also conducted robustness checks on this empirical design. And the second variable is given by, of course, the sovereign CDS, which is basically the average log spread of the 5-year CDS contract over the past months. We investigate different information periods with F1, 3, 6, 9, and 12 months, and holding period with age 1, 3, 6, 9, and 12 months. Okay, so it's very simple framework. We examine whether sovereign risk information, past sovereign risk, affect the future currency return. And what we do, we construct portfolio. So this is very much, you know, consistent with the literature on foreign exchange markets and on currency returns in general. So we sort portfolio by currency return on past sovereign CDS, okay? And what we are interested, as I said early on, is the sign of this coefficient beta 1, okay? And so the significance of this coefficient, and this is what we control, what we look at in our empirical analysis. In terms of data, we collect data from Thomson Reuters, ICON, for currency spot prices. And then we also collect sovereign CDS spread 5-year tenure, because this is the most liquid maturity of this contract, from market. Our sample span from January 2007 to March 2021. And we use monthly observation data for 48 countries with 32 currency globally. Of course, we have also in our sample European countries, and therefore we have a special treatment for Euro. And because we are interested only in the cross-sectional effect on currency return, we only consider, of course, a single currency, which is, of course, the Euro, for the countries of the European Monetary Union, that we of course include in our analysis. This chart shows a summary statistics. We can observe that over a sample period, the currency are stable. And by the way, we also include developing countries, and the number of developing countries is locally equal to the number of developed countries in our sample. Now, as I said earlier on, we test the effect of the past cross-sectional sovereign credit risk on currency return on portfolio level. And specifically, on each month, we sort the currency based on the past level of sovereign credit risk into 5 portfolios. And then what we analyze is the currency return difference between portfolio. Because, as I said before, there is a negative relationship between currency and sovereign credit risk, the portfolio spread that we report in our analysis is the low minus I portfolio spread. Okay, so this is what we should, in the next few slides, focus your attention on, because this is basically the variable of interest in this analysis. Now, this is the first set of results, the portfolio results, and what we can observe is that our results are statistically and economically significant. The row reports the currency return portfolio. So basically, these are based on different information periods from low to high. The column reports the 1 month currency return portfolio based on different levels of credit risk. Okay, so P15 basically means currency portfolio return from the lowest past level of sovereign credit risk to the highest. As we can observe in this from this table, all the results are statistically significant, and the portfolio return become negative with worsening sovereign credit risk, as we would expect from all sort theory. Okay. In this chart, we show the low minus I portfolio spread results, again, for different holding periods and different information periods. And again, all the results are statistically and economically significant for all holding information periods. Okay, these are the new USD statistics reported in brackets. Okay. Overall, we found statistically significant results that basically demonstrate empirically our hypothesis of sovereign currency momentum return for all the countries, 48 countries and currency globally that we include in our sample. Empirically, this indicates that currency is priced by the level of sovereign credit risk. So sovereign credit risk has a significant effect on currency pricing. And this showed the existence of a sovereign momentum effect on currency return. Now, what we now conduct in the paper is a set of robustness tests. So we consider excess return using the US 1 month rate as the risk-free rate. We control for equity, currency, and CDS systematic factors. We also conduct double sorting exercise, conditional currency momentum, conditional on countries' currency regimes using, for example, unpegged currencies. We conduct panel regression control for country-specific macroeconomic and financial market conditions. And overall, what we found is that the effect seemed to be more pronounced for developing countries, not developed countries. This table shows the first sets of robustness test results. When we control for the classical equity factors introduced by Fama-French Carrel factors, we also control for currency and CDS factors, and we utilize also the cross-sectional average, which is the market factor variable, basically momentum. So this is based on past 12 months winner and loser spread. This is our regression equation, okay? And it turned out that alpha is significant when controlling for our set of systematic factors. So this tends, in a sense, to rule out, the possibility that if all the factors are significant, then what is left in terms of sovereign risk momentum effect. Well, actually, because alpha is significant when controlling, this confirms our hypothesis that there exists a currency, a sovereign momentum return for our sample of currencies. Okay. We also control for country-specific characteristics. So we use a set of standard macroeconomic variables. So we control for past currency return, past change of sovereign credit risk, relative inflation. We utilize growth in GDP, fiscal deficit, and interest rate differential. Again, what we found here is we found statistically significant beta 1 for all the results. So that again supports our hypothesis of the existence of a sovereign risk momentum effect for our panel of countries. Of course, the results, I don't have enough time to go onto the specifics, but the results are, of course, tend to, the magnitude tend to diverge among variables. In particular, for GDP and relative inflation, the results tend to be to hold stronger than for other variables. The further step we also include in this analysis period of crisis, financial crisis. In particular, we consider the global financial crisis, so 2007, 2008, the European sovereign debt crisis, so January 2009, June 2012, and the COVID-19 pandemic. So this is most recent events from February 2020 to 2021, end of 2021. And what is interesting is to consider the interaction of period of financial crisis with basically abnormal CDS stem structure. And what we basically refer as abnormal CDS stem structure is the negative CDS slope, which is basically the 1 year when a negative CDS slope occurs when the 1 year CDS spread is larger than the 10-year value. And the convex stem structure, so basically the average of the 1 year and the 10-year spreads are larger than the 5-year spread. So basically our further innovation in this paper is that we also analyze convexity, which has been neglected to the best of our knowledge in previous empirical research focused on sovereign credit risk and currency returns. And this table summarizes the main findings. And in general, what we found is that all the alpha are still significant, statistically significant. And this, in a sense, confirms that the sovereign momentum effect is not driven by abnormal events. Okay? So the results tend to be significant only when the abnormal term structure, for example, a convex term structure, is combined or interacts with a crisis period. Okay, so this is, I think, also a very illustrative results, very useful to understand better, this relationship between sovereign credit risk and currency returns. And finally, our next step is also to consider the information flow of the sovereign CDS data. So, one might argue, okay, I buy your results. I think these results are statistically and economically significant and important. However, one might argue that the short-term currency return is mostly affected by the most recent past sovereign CDS information rather than ancient oldest data. Therefore, to further test if the ancient information that affect the currency return, we perform these empirical tests. This regression, very simple, where basically delta SCDS TA-TB is log spread changes between month TA and TB for sovereign CDS. Okay, we are interested in understanding monthly changes in sovereign CDS of the last 12 months. This table summarizes the main results. So what we found is that the short-term currency return is more related to actually recent information. However, the ancient information, okay, so if we look at less recent information, seem to be still influential on short-term currency return. And therefore, these results tend to confirm the importance of looking at the history of sovereign CDS market data, because even less recent CDS market data may actually have an impact on future currency return for different holding periods, as we have seen earlier in my previous presentation. So let me summarize, my brief keynote speech on this conference. In this paper, we document a sovereign momentum currency return. So we found that past up to 12 months sovereign risk information by using sovereign CDS spread can predict future currency return up to 12 months for different holding periods. Therefore, we show a significant cross-sectional currency portfolio spread between the highest and the lowest quintile sovereign credit risk. As I also briefly discussed today, we also show that the sovereign momentum currency return is robust for several robustness tests. In particular, we found that the sovereign momentum currency effect is particularly pronounced during abnormal events, especially when these interact with, we have seen crisis periods, okay? And we also provide additional evidence on the relevance of sovereign CDS information flow. Okay, I'll stop here my presentation. Thank you very much for inviting me to this conference. And if you have any question, please email me. I will be very happy to, or if you have also some suggestion for possible direction of research or a possible improvements on this paper, please send me an email, drop me an email. I will be very happy and pleased to, to get your feedback and your comments or suggestion on this paper. Thank you again, and goodbye.